Hi everyone. So, I've been thinking about doing this for a while, and this is going to be the first video, I hope, in a series of videos, and I've broken it down into different categories. Mindset, how traders need to be thinking, because there are questions and areas you have to develop there. Then there's obviously techniques, which is what we're doing now. So today's video is about ways in which traders do things. So the ways in which they do it, not strictly speaking what platform they use, not necessarily what tools they use, as in kind of which indicators per se, but the ways in which they use those indicators. And then of course we can talk about which tools there are, and then we need to talk about general analysis. And I think live trading can fall under one of those categories. It's up to you to give me feedback on that. So first of all, excuse the informal approach. It's Saturday and I just feel like recording. I want to get the first video out. I'm really excited about this, and so I want to do this. So first of all, let me give you some background behind myself, because many of you probably don't know who I am, but this is my second career. So this is actually my second career. I sold my shares successfully or at least sold my shares in a successful company that used to do visual effects and animation. So kind of like the Toy Story, or really nice, really cool animation that you see for television and film. Anyway, and after that, the problem was that I moved overseas as well, and what I wanted to do then was take control of my own personal finances. And so I sort of got into that. Now, I was a little bit all over the place, spent a lot of money on very mediocre education, and then actually came across Nick McDonald at the time, who had founded a company called Trade with Precision, which was then doing market analysis for a range of clients. But there was a newsletter for the ICE, which is the Intercontinental Exchange in the US, and I was following it every week, purely technical analysis, while I was trying to become more consistently profitable on my own. And his analysis was just bang on every single week. And so part of that was because he was purely technical. And I appreciate that that's a big debate for many people, is, how it's hard to let go of like meaning, or, we think that if we let go of listening to the news or allowing the news to influence our trading, that we're saying it doesn't mean anything. And it's strictly speaking, I mean, humans tend to love drama, so we do create a lot. Otherwise the Kardashians wouldn't have come into existence. But for trading, it's not necessarily as constructive as people think. And so that transformed my trading. So much so that I ended up working in the city as a trader. And then at that time, I'd been sort of trading for myself and in the city for a while. And then I had stayed in touch with Trade with Precision. And then I was invited, and I think very happy, like it was just a dream thing for me to be able to join the team and to provide technical analysis. And in fact, I ended up doing, at some point then, taking over, Nick stepping back, and then I ended up doing technical analysis. And in fact, if you look at kind of some of the brands that are here, I'm proudest, or there's so many of them that I'm proudly associated with. And again, enjoying providing that technical analysis. So what I want to do in this video, I think we can sort of move on from this. There's a range, the number is limited. I mean, there's more clients in this, but this gives you a sense of who I am. I do speak at events. I love it because trading only takes an hour or two at most a day. It does leave you with a lot of time. So once you've hit the gym, once you've hit the coffee shops, once you've gorged yourself on Netflix and Prime and Disney, there's just, eventually you need some greater purpose. And so for me, I find that interacting with people, and I find like writing a book, which I'm doing at the moment, and mentoring are for me the most constructive. Mentoring, for example, actually improves my trading because I have to continually rationalize my thoughts and explain why I'm doing certain things, which reinforces them, because I can't bullshit, my way around. So just to carry on from this, let's have a look at this. Okay, so mixed results. Okay, so this is what a trader or an analyst is, an analyst or a trader who I don't believe is consistently profitable, or maybe not even trading. This is kind of what their charts tend to look like. Now, all I really did, literally, you could do this yourself, was a Google search, technical analysis charts. That's all I did. And these showed up in the page of results, which to me is frightening, because this is meant to be what comes up in Google as examples of technical analysis. And so for me, my experience has been that if somebody's charts looks like this, they are not consistently profitable. And I appreciate that I could be wrong in that respect, but that has been my personal anecdotal experience. If you imagine you're driving in your car and you've got all this crap on your windscreen, mud and dirt and dust and everything, you can't really see what's going on. And so the layering indicators and all kinds of various other instruments on top makes it incredibly difficult, I believe, to make clear, calm, rational decisions. Now, in amongst this, I can sort of see why each, on the slide in front of us, there's a couple of things where I can sort of see why the moving averages here and what these little indicators, how they might work. Now, if you trade for an institution, believe it or not, you don't necessarily have free reign. You might think that's obvious, but you don't have free reign, which means that you can't just take trades anywhere you want. You really need to justify to the powers that be why you took a trade. And so actually institutional traders are probably, or in my experience at least, are under a lot of pressure to justify trades. So indicators, when they're presented like this, it helps protect them by going, well, this indicator said that gave me a green light, that gave me a green light, that gave me a green light, so that's why I took the trade. And don't assume, by the way, that all institutional traders are consistently profitable. There's lots of people out there that fake their way through every type of job in the world. They exist in trading as well. I'm just telling you that this is not what professional traders look like. And I did not go out of my way. This you can find. If you just Google it, this stuff, all these exact images should come up in your same search results. So the point is, where I'm going with this is that actually, as you become more and more experienced as a trader, you need fewer and fewer gadgets to help you read price action. The irony is that putting lots of gadgets on your screen slows down your process, your learning process of getting to that point where you can read price action successfully. It gets in your way. Some of the tools that I will talk about in subsequent videos are really good because they don't really clutter things up. They help organize the information that we have. So this is ridiculous. I mean, this is absolutely insane when I look at this one. I'm going, maybe that image was put up exactly to prove my point for me. Somebody else put something up and just made it a bird's nest to kind of show you what goes wrong. This looks more feasible to me. This looks as though somebody is using these to create probably an algorithm, and they're looking for multiple indicators. Really, one of the biggest problems with algorithms is trying to get it to not take bad trades. It's really easy to get a system or a robot to take good trades because it does that, but you can't stop them from taking bad trades, meaning the amount of filters you need to stop it from getting into a bad trade when everything looks really messy is actually harder to do than getting it when everything looks perfect to take the trade. So it might not make sense, but it will at some point. So anyway, this is really a clue. This is not what I believe an experienced or successful trader's charts would look like. Your goal is to ultimately strip everything away to reduce it down to its core. Okay, so then also the next thing that I wanted to do is break this into categories, the analyst. So you get analysts, city analysts, you get professional analysts, they've been doing it for years. And what they do is they use tools, and for example, moving averages or horizontal support and resistance levels to organize the chart price action into in a way that allows us to determine, okay, this is kind of what's going on. So they frame it or they organize it into definable areas, and then they list potential outcomes. They're like, okay, well, it could do this or it could do that because this is what I put in there. You've got fib levels. And by the way, I'm a big fan of fib levels. I'm a big fan of pivot levels, moving averages, all those different kinds of things. But really the purpose of my videos would be ultimately to get people to be able to be confident in actual practical day trading to earn a secondary or primary source of income. That's it. Practical, real-world trading, as opposed to theory. So the problem with it is that it serves too many masters. They are under great pressure from regulatory bodies to not, strictly speaking, give financial advice. So what they can do is outlay, this is what the language of the market, the body language of the market is saying, and therefore it's probably, and then try to imply that it's probably going to go more one way than another. So it's very vague and usually quite complicated. And again, they'll put more and more stuff in it to justify the reasoning behind stuff. But they're not necessarily traders. And this is actually a really important distinction. Not all analysts are traders. You can get people who are analysts who literally submit their analysis and it goes out and then it goes to the traders as supporting information or supplementary information. Then you get traders. So the traditional approach. So the traditional approach is that traders will also use trend lines. We're talking about trend lines today. Trend lines will also use it to organize and package channels and package price action into these definable areas, and then weight which is the most likely outcome. And this is slightly different because here they're actually going, well, listen, if it breaks to the upside, then I might look for a potential entry here, especially if it retests the trend line from the other side. And actually, I should say at this point as a disclaimer that I'm still like, the beauty of becoming a master trader is that at some point you become profitable. And then you become consistently profitable. And then you get to a point where you start really getting the hang of tighter entries, tighter stop losses. You start to really start to squeeze your way around the market with much more confidence. And again, that'll be with fewer and fewer indicators. So the traditional trader's approach, and why I'm saying that is because somebody might say to me, listen, no, I use trend lines like this and they are 100% reliable, and I'm very much open to exploring that. But in my experience with the training that I've had, official training I've had, and all the books I've read on it, although they offer lots of evidence of it working, the goal of a trader is to reduce the number of tools that you have to rely on to be consistently profitable. And trend lines could be dropped. I mean, that's a bit of I recognize that could be a bit of an inflammatory comment. What is wrong with me? But it's possible that you could trade without trend lines. Really, you can just trade without trend lines. So the whole reason I wanted to do this video, sorry to kind of waffle around and get to the point, is that I'm going to propose a different way of using the same idea, or a different approach to using trend lines, which I think offers a lot more benefit. Okay, so again, the difference is analysts not necessarily going to trade it. The information is a little bit too vague, looks pretty cool on the chart, but doesn't really do much. The traditional trader's approach is yes to do it, but the problem is that when it comes to exact entries or potential success rates, the trend lines can be very iffy. Kind of like using a MACD crossover. There are times when it works perfectly, and then there's a lot of times where it doesn't work perfectly, and that is not acceptable to a master trader. Master trader is like, no, this has got to be something that I can rely on 70, 80, 90% of the time at most, or at least, to make sure that I get those results. So the master trader's approach is as follows. I'm going to go to the charts and I'm going to show you this. The master trader's approach is, we first of all are always looking at price action. Okay, so you're a master trader. The first thing that you look at on the chart before anything else is the candlesticks, the price action. That's it. Usually, the second thing that you might do then is look at support and resistance levels. So if we look at this image that I've got on the right-hand side, the first thing I notice when I look at price action, and it's important that we consciously direct our mind to focus on the most important thing, especially in trading, because there's so much noise and so much clutter that you have to be trained to teach yourself to know what it is you should be focusing on. And so with this, the first thing we do is we look at the price action. The price action is the candlesticks, the sequence of candlesticks, especially the sequence of lows. So if I look at this price action in isolation, what can I tell you about it? Well, it is generally trending higher. Cool. Is it choppy or is it trending smoothly? I think that this is a relatively decent trade. I went through the charts pretty quickly, grabbed something that was a semi-decent example of what I'm looking for. So the point here is that I am looking for a trend to the upside. I'm a trend-based trader. I'm looking for a trend to the upside. And what I really want to do is make sure that what we're talking about now is that the angle at which price moves is really also a supporting factor in whether we should trade it or not. Okay, if a market is going sideways, it's not going anywhere, it has no momentum, it can usually be very choppy and very high risk to trade. So the markets that are the most attractive to us are the ones that are actually moving and therefore usually have an angle of momentum. If they're moving straight up very aggressively, they could be going parabolic. Obviously, the momentum is very aggressive. And if they're going in a slight sort of slow, steady angle, then it's got a nice steady momentum. But the point is there is a type of angle approach to it. Okay, so this is the point, is that the price action has a momentum that is displayed in its angle, in the overall angle, in the way in which it's going up or down the chart. So in this case, you can see that it is trending higher. I should say, if you look at the video and I'm here, it's trending higher like this. And actually, so what we're doing is when we put that trend line in, we're really saying that, look, as long as it stays on this side or on this side of it, we're principally bullish. Everything is looking pretty cool. And I don't necessarily, and this is the difference, I don't necessarily have to connect it with any particular lows. I can just place it there as an angle. I'm really saying that at this particular point in time, and this was on a 1 hour time frame, this momentum is looking really good. So as long as it stays up above this angle, the momentum is still strong, which means it's still relatively safe for me to trade. That's the key thing. Let me repeat that. As long as it stays above here, this angle of momentum is still quite strong, and therefore that momentum is staying there. The market is not becoming exhausted, and therefore it's still, relatively speaking, safer for me to trade as a buyer. Once it breaches that line, it is losing momentum. And this is the important concept to take away from it. It is losing momentum. And so the problem is that while it's looking really nice, we've got some good strong trends going. This is Euro Aussie. So this is stuff that I traded on Thursday. And it's beautiful because it was really aggressive in its moves, considering how much of the market last week was a little bit all over the place. But once this starts to breach that line, it's an indication, it's an early indication that it is losing momentum. And so that puts me on caution. It's not to say I become a seller. It means, because actually it's really until it breaks these structural lows. If it doesn't break those structural lows, in principle, I'm still bullish, but it does mean the momentum is shifting. It means that either the market is now going to go into a consolidation phase, and then after the consolidation phase, it could continue. So there might be a breakout trade, or it might start to head a little bit lower. And that's really it. It's the earliest clue that you can get before you break a structural low that the momentum in the direction you're trading is now potentially waning. And then it prevents you from, it might be a clue that you take profit, or it might prevent you from taking another trade. Sorry about that. And so that is really that clue. So that's really the most appropriate way to do it. So basically think of it as an additional confirmation of momentum in trending markets. And so yes, if the price responds really well to it, then that's a bonus, but that shouldn't be the primary reason to use the trend line. Your main thing is really using price action. And so the trend line is just there as kind of a line in the sand saying, look, if I stay above this, or in a downtrend, if I stay below this, this downtrend is looking really nice and bearish. So case in point, let's go to the charts and let's have a look. Let me show you a few things. So Aussie yen. Okay, so Aussie yen, it's a 4 hour time frame. Doesn't really matter so much at this point, but you can see that there's a beautiful, very nice, very bearish downtrend here. Okay, so remember that if I'm going to be trading this as a day trader, I'm going to be really only active today. Let's imagine this is a Monday or Tuesday or Wednesday. I'm going to be active in the markets for 3 candles. Like that's 12 hours, 12 hours, give or take, that I'm going to be somewhere in there. I need to find a trade on the lower time frame. So it's a very small period of time. So if I go down to a lower time frame, let's go down to 1 hour. You can see market still trending. There was a bit of a break down below this level. Excuse me. And actually, here's the thing, right? At some point, a market becomes too overextended, and it's going to do a correction or a retracement on the higher time frame, and then I might not want to get in. So this has had quite a fast movement to the downside, and so I want to be clued in as quickly as possible that that is now potentially shifting to come back up. And if I was looking to short that, then I want to make sure that actually, no, this is going to be a bigger correction. So let's go down to the 15 minutes, straight down to the 15 minutes. And then actually what I'm going to do is go a little bit further, go down to the 5 minutes. Okay, so this is what I want you to see. There's quite a bit of angular momentum here. You can see that actually it starts out quite steep. So let's kind of draw it like that. It starts out quite steep at this point. And then it's slowly, you can see the angle starts to shift a little bit here. And the angle shifts at this point. It's now going sideways. Okay, so big, nice, progressive moves to the downside. A couple of entry opportunities on the lower time frames. I'm usually on the 15 minute, but on the 5 minute, this was moving so fast that you have to kind of go down to the 5 minutes. You can go down to the 1 minutes as well. So it doesn't always, by the way, have to be the 5 minutes or the 1 minute. 15 minutes is beautiful for day trading. But you can see here that the angle has actually started to shift. And then of course here it's going sideways. And so really the purpose of using that trend line as just as a guide on your chart, just something there that you can watch out of the corner of your eye, would be the purpose here that if you are looking to get in, as soon as you see potentially price starting to breach that, like it does at that point, so it does over here, that is your first clue that, oh, okay, it's losing momentum. because you obviously want to, there's a couple of potential trades here. So here, for example, here's a break below this price action here. There's another bit of a consolidation, and here you can see there's a bit of a level here. Price breaks below that, rejects it, carries on down. So there's a couple of trading opportunities in there. However, here it starts to go sideways a bit and breaches that. And it doesn't just breach it in a minor fashion. A couple of candles in, it's definitely over the line. And that means that momentum that we did have there is gone. And then, of course, what happens is if I draw a second one, so price is now sort of doing this, and there's a bit of a second one. And again, don't worry, you can see I'm not being too precise with it. Just if it's like that, if it's generally covering that angle, you can see at this point we break through it. And to me, that single candle that breaks above that level is a clear signal that that it's done for now. That move was already slowing down, it's done, and then it continues to go sideways. But that single candle breaking through that trend line is now a signal. Forget about the 5 minutes. Okay, this momentum is done for now. The only way that that could potentially continue is if it then broke these lows and then started to pick up speed again. So it's kind of slowing down, angles changing, and then it's got to break the lows and pick up speed again. And so I don't think it's going to do that. And why do I not think it's going to do that? Well, because it's been running and running and running from 2:15 in the afternoon until 6 o'clock at night. It's done for the day. So hopefully that kind of makes sense to you. I think let's go ahead and do it on a different, let's go look at a different chart and just kind of get rid of that. So, okay, so I'm on gold. Now, for the purposes of this video, so again, to repeat, as you become more and more confident in your trading, you need less and less on your chart. You don't need moving averages. You don't necessarily need Fibonacci or pivot levels. And they are all very powerful, useful tools, but you need less and less. So here we're talking about the concept of really the momentum of the market. It's safer for us to trade in a market that is intent on going in a particular direction. And so here's a great example. So we're just looking at this. So you can see that while there was a mess of a consolidation just after NFP. In that run up to NFP, here's NFP coming out non-farm payroll, mess of a consolidation, and then it decides to kick off. And again, that strong bullish candle breaks out of that and starts taking off. So now you have, I'm purposefully not going to put it on against any price action. But here you can see, if you just kind of do that, even if you do this, it doesn't really matter ultimately whether you put it there or whether you put it here. You can see that the momentum is quite aggressive, starts to head up to the upside. So in a way, you have this as quite a strong momentum. And actually almost, so what I'm going to do is just do this. I'm actually, these lows and these lows here, higher lows, high highs, you can see it breaches it a little bit there and then consolidates and then kind of goes up here. But the fact that it breached it at this point means that this momentum here, because the markets shift, the speed, the picking up, slowing down is going to happen throughout the day. And when it starts picking up, you want to know that you want to notice it's picking up. And also as soon as it starts slowing down, you want to notice that as well. Because that might say, listen, take some profit or get out the trade or just it's done. It's overextended. It's done for the day. Here you can see that it did a breakout. It managed to continue to the upside. Then it started breaching it, which you're not sure if it's going to change or not. Went up a little bit and then came back down below that line. And in fact, then if you really want to be touchy, it actually broke that angle as well. So if you drew in a second trend line and breached that, that's now two, in my mind, that's now two signals from the market that momentum is waning and pretty much dying. And of course, by that time, especially when you have this big bearish candle breaking through that line to the downside, it's now 8 o'clock, 9 o'clock on a Friday night. It's done. I mean, that's obvious in hindsight, but if that was even a Monday night or a Tuesday night, the clue would be the same. So here we go. So now we have got a sideways market. So, okay, so fine, Adam, so that's all really nice. And I love your Rick and Morty t-shirt. But here's the thing now. So what's going to happen now? Okay, so the first thing we need to do effectively, if we're looking at this, and this is, some people like to trade one instrument. I prefer on a given day to go look and see what is moving first. And if there's nothing moving, then I'll see, okay, what looks like it's about to move and then go for that. So, but some people are like, no, I only trade gold, or I only trade the DAX, or I only trade the FTSE or euro dollar. So let's just say that we were kind of going to go trade gold. Although we have a little bit of a head and shoulders here, let's just say for the time being that we are in a consolidation. Okay, so let's just say that we are in a bit of a consolidation like this, and basically we're waiting to see what it's going to do. Again, what would happen then is if it ultimately breaks out to the downside, then I would start potentially by just drawing a line in that once I've seen it come back and go. And so that would help give me that guide. As long as it's below that level, I can start continuing to short it. And again, if it breaks back out and comes back, starts to break over the line, it's losing that bearish momentum. And vice versa, if it starts breaking to the upside, I'm going to start to draw a line underneath it. And again, sometimes I don't even do that. I'm just following price action. But I wanted to show you today as a master trader, again, what you're doing is you're just saying, okay, look at that. Wow, it's, it's moving at quite a pace. And sometimes you won't even be getting in until price has already touched and moved. So in other words, it's already given you, let's call it a baseline. It's given you a baseline angle of momentum. And that's the thing, it should pick up. The stronger the trend is, the more it should actually start to accelerate and go away from the trend line rather than go towards it. But it's a great indicator of a loss of momentum that you could probably spot by eye, but having that there is just a great little thing that you go away from, you go make yourself a cup of tea, come back to the desk, oh, wow, it's okay, it's broken through that. Okay, definitely means that bullish momentum, if I was a buyer 20 minutes ago, I'm not now. And then you have to get, the market has to prove it to you. So the market then has to break back up and go back up into a trend again and start showing you that. So hopefully that kind of makes sense to you. Let's wrap it up here, and then I will potentially do a follow-up video if I get some feedback from you or any other questions, and I'll do a follow-up video on that. Let me know your thoughts, and let's take it from there.